feat for me to say, wow, this actually really worked. And it was really cool.
1031 is a way to shelter your income when you sell the thing. The DST is a way to avoid the 1031 and not have to suffer the time penalty.
Our career and during different tax periods, we've seen, these tax avoidance, tax minimization, offshore, all these different strategies undertaken to minimize or avoid taxes. And then I can tell you that, some of them are just not worth the trouble. And so I was skeptical. Admittedly, I was skeptical. I thought, oh yeah, here we go, another one of these, right? And then they say, no, it really is different, right? So to look more closely, we looked more closely. We had, honestly, 2 years of conversations. 2 years. Now we were being due diligence at the same time that we were doing due diligence, but 2 years is a long time to be, sort of flirting with the idea of and getting to know the people and getting to really understand the transaction. Yeah, long story short, we got comfortable, although we are not tax attorneys, lawyers, or estate planning attorneys, that at least, from an investment perspective, that, it made sense to sell a highly appreciated asset, get liquid, hold that in this type of a deferred or installment sale type of instrument, and then just be in a position then to do the most important thing. I'm probably stealing your next question, which is time. They say, well, you can't make more time. You can. The deferred sales trust, in a way, allows you to lengthen the investment time horizon for those assets after getting liquid, but before having to feel the tax impact. And from an investment manager's perspective, time horizon is the most important element in investing.
All right, everybody. Hello and welcome to another Capital Gains Tax Solutions Mastermind, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the deferred sales trust is an amazing way for you to exit businesses, real estate, cryptocurrency, luxury homes, S Corps, C Corps, LLCs, separate partnerships, unlock the freedoms that you desire and pertains to location, time, energy, entrepreneurial freedom, and solving the big challenge, which is capital gains tax. And what amount is that? Well, it's typically about 25 to 50, up to 60 or 70% of your gain is going to be wiped out by capital gains tax and depreciation recapture, depending on what state you live in, depending on what asset you're selling, and depending on how much depreciation you've taken over the years. And for those that know me, my name is Brett Swartz, and each week we kind of mastermind and hang out together as a part of a way for you to get to know, like, and trust us, as well as bring live deals to the mastermind here to dissect, ask frequently asked questions, talk about deal close stories of the week, talk about escrows that are going on, and really just document our journey along the way. Because guess what? We're still learning every single day ways to build wealth and ways to sharpen our skill set. And I am joined by some amazing individuals, including Strategic Alliances. We have Rebecca Munson here up in Lake Tahoe, Truckee area. She's an expert real estate agent there. Rebecca, how are you doing today?
Great, Brett. I'm doing well. Thanks for asking.
Absolutely. We also have Jake Miller. Jake Miller is a certified financial planner. He's an entrepreneur, and he is our go-to top financial planner in the country. Jake Miller, how are we doing today?
Doing wonderful, Brett. It's always good to be here every Friday talking about the deferred sales trust and how we're helping people maximize their wealth and lower their taxes.
Absolutely. I like the shirt today. It's looking good. The hair is always on point. Fantastic. That being said, I'm not sure if Pierce is in the house or not, but he may or may not come here today. He's down in Newport Beach, commercial real estate agent and luxury realtor there. So today's topic is just pretty simple: exiting $1 million businesses or real estate. We're also going to be tying in some crypto. In fact, I had a big call yesterday with a potential gentleman who has a lot of folks that he works with in regards to highly appreciated cryptocurrency. And so we're going to tie that in today as well. But I'm going to start with, I think our favorite here, which is ChatGPT. And so I'm encouraging everyone who's listening, especially if you are in sales, marketing, or consulting, as a way to help to market, write copy, and essentially bring to life perhaps the vision or the story that's in your mind using a software like ChatGPT. But I basically said, write an allegorical story about me helping my client in the first point of view, exit a $5 million worth of Ethereum. And this came to mind because of the call I had yesterday, and I found myself telling the story to this gentleman who, it's interesting. He says, Brad, I've been approached and I looked at a lot of different trusts over the years, and it's this kind of the same story. The person calls me, says they have like the magic trust and it can do all these amazing things, and but it's never been through the IRS audits, and there's a person who knows a person who does the legal work, and they may or may not have done the audits, and it's just kind of this this thing where it sounds amazing, but once you start digging in, he goes, the legal documents, aren't drafted by the person or the person that is the legal person that they know. They haven't been through the audits. They haven't done very many. And, he goes, it quickly just says, forget about it. So much so that he's considering moving to Puerto Rico. And so I quickly said, well, we're not that. Let me tell you why we're different. And we like to say we're the strategy where you don't have to move to Puerto Rico. You can keep that location freedom in mind where you want to live and still have the tax deferral. And that's the key. It's not taxable, it's just tax deferral. And he goes, okay, well, tell me more. And so I went on to say that, we're direct to the creator of the structure who's been also direct to the clients who've been audited. And those have all been no change, no findings. And it's close to 30 years. And I said, that's the foundation of this. If it wasn't for that, we wouldn't be here. And we wouldn't be here on this mastermind because it hasn't been proven in a way. And so for us, that's what gives us the confidence. So back to this. So I said, write me a story of this, of the client that I helped who exited this, $5 million Ethereum exit. And so I just kind of laid out some of the key facts. And so this is kind of the story. It says, in the pale light of a spring Saturday morning, and this is true, I was driving to Walnut Creek to do some insurance training course for a Saturday. And typically I'm not working on Saturdays, just hanging out with the family, but it's early in the morning and I get a call on the way there. And this particular client lives in the Oakland area, kind of the Oakland Hills. And he's like, Brett, hey, really sorry to bother you. His name's Peter. He goes, I'm really sorry to bother you, but Ethereum just hit 3,000 last night. I didn't expect it to go up that fast in this last 24, 48 hours. And previous to this, he had bought Ethereum, purchased about $100,000 worth, and it went as high as about $10, $13 million. And then it had dropped to like 6 and 5. And if you guys remember some of the stories, if you've been on our masterminds, his wife learned about the Ethereum investment going to 6 million, about a year and a half prior to that. And because guess what? We hadn't done an exit yet, right? We hadn't actually exited Ethereum or Bitcoin into the DST. We've done multiple DSTs. And so back to the Saturday morning, it's this kind of a surreal moment because they had gone up and down, their emotions up and down, their freedoms up and down for what was going to be the exit. Then they finally settled on the deferred sales trust just for the marketplace to drop. And so fast forward, now it's coming back. And so finally they have the strategy, they have the timing and execution, the time they want to execute. And now it's time to execute. And our whole plan has always been to make sure that I was at my own office that is securely, not like some random Starbucks Wi-Fi to make these trades, to be able to log on to Kraken, which was a whole nother story to even get Kraken on board to open up these deferred sales trust accounts. So here we are. It's a Saturday morning. He's calling me, and now I'm on the road. Didn't expect it. He's like, "Where are you at, Brett? I'm really sorry to bother you." I'm like, I can be at a Starbucks, but that's not secure. He's like, "Yeah." He's like, "Well, what are the codes?" I'm like, "Well, I can read you the codes, And this began like an hour and a half period. I'm reading off, I call them the launch codes, right? It's like the football. And I'm reading off the codes, and he's making small transfers, bigger transfers, bigger transfers. And so within about an hour, hour and a half, one was at, $200, one was $250,000, one's at $1 million, then it's another 2 million. And essentially 5 million is exited in about an hour and a half. And so anyways, that's the story. That's what happened. And so I'm having ChatGPT write this story, but I'm going to pause because I'm talking a lot, and I want Jake to come on in and share any insights that he gleaned from that story. What do you like, Jake, and what do you take from that?
A lot of people wonder and they ask, well, why do I need a trustee? And I think this is alter confirmation in this type of scenario where there's a lot of trigger action. When I say trigger action, there's somebody doing something all of the time, and there's coordination going back and forth. And the nice thing about that is, because you're not doing it yourself, this strategy works. It has legitimacy. There's no constructive receipt. There's somebody else performing a lot of the actions. And that's incredibly important for the legitimacy of the strategy as well as for the deferral of what we're selling and what we're reinvesting in, and how we're able to continue this deferral forward until at some point in the future you actually do take it as a distribution. And so I wanted to make that point very clear and help everybody understand the necessity of leveling up your team. If you're going to save more taxes than you've ever saved before in your life through a strategy like the deferred sales trust, now you need an appropriate mechanism in place, which is the structure of the trust, as well as the team to help you make the trust structure a success.
Absolutely. And by the way, the deferred sales trust, it's kind of like a 1031 exchange or an IRA or a 401k. There's third-party groups or administrators that are having the funds, that are holding the funds or investing the funds with your approval, of course, that report, properly to the taxing authorities. And as you receive income back, you'll get a 1099, or you'll report the principal that you receive and you'll pay tax on. And so it takes these team of professionals to execute the strategy, but ultimately the outcome, although it does feel and can, seem like it's complex, especially up front to get everything set up, once it's in and once it's deferred and once it's reported, especially in that first year, it's really like clockwork at that point. It just becomes a matter of when you want to invest into different things, which can be back into cryptocurrency. A lot of our clients like to go into real estate, and a lot of also like to stay diversified and have a portfolio of liquid investments and stocks, bonds, mutual funds, depending on their risk tolerance and their preference for investments. But the key is building a team to help you execute what it is that you're trying to achieve. Our goal and one of our main focus is first understanding A, where you're at, your tax challenges, B, where you're trying to go, and then what strategy or strategies that we can implement to help you achieve the outcome, which is building more wealth and deferring more tax. And so, that is a good review of that. And Rebecca, I want to bring you in here because you're in luxury real estate up in Truckee, Tahoe area, and you see perhaps some clients that are living in these houses that are subject to huge capital gains tax, even their primary homes. We'll talk about the power of the deferred sales trust to give someone an opportunity to exit their high-end primary luxury home and defer tax and be able to have some freedoms and some cash flow from the trust.
Yeah, so it's a great opportunity, certainly with anybody who's got, lots of capital, lots of equity in their home, primary home, second home even, because the second home doesn't qualify for a 1031 typically if they haven't rented it out. But it's a great opportunity for people to exit, put the money in the deferred sales trust, be able to take some time, figure out what they want to do, maybe rent, maybe they have another home they can live in, maybe travel, and be able to then live on maybe the interest that's coming from the deferred sales trust, maybe take portions out of it, maybe partner with the deferred sales trust on some other investment opportunities. There's just so many possibilities. It's a pretty amazing tool.
Yeah.
I'm looking forward to getting to that point. We're about a little over a year away. So
yeah, you're away from selling because you guys only build places and then you sell them for clients. But you'll build spec homes, you and your husband do, which is great. So you're about a year and away. How are things going? Are things easing up as far as supplies and cost, or do you feel like they're about the same as they were last year, Rebecca?
So that's a great question. I get that to me a lot. As far as building goes, cost of lumber's gone down significantly, but the cost of labor has just continued to go up. There's just not enough people out there to do the job, so the cost of building is still expensive.
Yeah.
Say
Yeah,
the
part of the challenge, but what's nice is when you do go to exit, you have an extra, if your Truckee's in California and half of Lake Tahoe's in California,
Yeah.
you have an opportunity to defer that tax. On an investment property, 37 is the minimum, right? If you have
Right.
depreciation recapture, it can be around 40% or even 45, depending on how long you've owned it. Yours, you're owning it less than, probably you're not taking a lot of depreciation. So you're probably around 37 would be the amount that you'll be able to defer. So let's do a scenario. Let's imagine you bought or built a house for $1 million, and let's just say you're going to sell it for $3 million. That's a $2 million gain. On that $2 million gain, you times that by 37%. You're looking at $370,000 per million. So that'd be 670. That'd be what, 730 about, or 740?
Yeah.
I think I did the math right. So $740,000 is what we're talking about here, right? So if you're listening to this and you're looking at selling your home, or selling a property or a business or cryptocurrency, you want to understand that math that we just did, state, federal, and then it could be Obamacare tax could also apply as well, depending on what kind of asset you're selling. And that's when you want to identify that. We'll help you do that too. You can go to capitalgainstaxsolutions.com. You can download our free ebook, and we also can run that calculation with you. Here's the key: you got to have $1 million net proceeds, $1 million gain. That's very important. Jake, who else would this maybe not be for? If someone's listening to this, they're like, well, do I fit? Do I qualify? Talk about the qualifications and talk about who it might not be for.
Absolutely. In fact, I have a real life example. Just was on the phone with a real estate consultant that has a client. And she has 3 clients, and it's complicated because they're all family. There's the father, there's the son, and the daughter. The son has a fantastic plan of just waiting until the father dies to inherit the real estate, because then he gets to step up in basis, but he's also looking for the future appreciation and everything else to be more significant in the future. The father, through estate planning measures, feels like he should liquidate everything now and just distribute the cash or the proceeds, because if he were able to sell it and liquidate it now, for him, he won't have his kids squabbling over what it's going to look like in the future. Then, of course, there's the daughter. And I'm not stereotyping women or anything like that, but she's a little fickle. And she just doesn't, any given day, she doesn't know what she really wants. Sometimes she's with her brother, sometimes she's with her dad. And so it's difficult. Now, to make one of these 3 people happy, the trust is not a good fit. Meaning, if you're trying to just pass on to your heirs the physical, tangible asset, well, letting things run until the father passes away is the best course, and the trust is not the best fit. However, should you want to distribute the proceeds out to your kids and equalize the estate while you're still living, the trust could actually be the very best fit and the most tax efficient, because in incurring the sale that is typically taxable whenever it occurs, with the deferred sales trust, we're able to actually move that to the future. And he's able to effectively, with this and additional estate planning measures, equalize the estate for his kids now, while he's still in good health, still in the right state of mind, and still able to move forward. And so we're having those discussions. We don't have a result or a determination or a solution yet, but those are the discussions we're having right now. And that's an example of when it doesn't work as well as when it does work. And we're trying to decide what they want as a family.
Very well said. Yeah, it sounds like, and it feels like the father especially, and even the family, they want estate planning piece. You heard like a thing called financial peace with Dave Ramsey, right? Being debt free, having an emergency fund, having a clear budget, and then eventually having cash flowing producing assets. In this scenario, it sounds like he has a lot of financial freedom, but he may not have estate planning freedom and or even the time, energy, and the stress of continuing to own real estate or businesses in an environment that's becoming, for a lot of states and for a lot of owners in these who are operating in these states like a New York or New Jersey or Illinois or California, that are high tax states and high regulation states that, let's just say, aren't as friendly to you anymore with being business or real estate owners. And that creates, stress and just, ongoing stuff, toilets, trash, termites, liability. And you take that and you couple that with, wow, I don't want that stress to be passed to my kids. Or like you said, one child, I have a client in San Francisco, very similar, has a big house that he inherited from his family, his parents about 30 years ago. They had it for, 30, 40 years prior to that. The basis is very low, looks over the ocean, and one daughter wants to do one thing, one son wants to do another, the third is somewhere in between, and the fourth really doesn't care, right? And dad's like, and everyone's looking at dad, and dad's having to have these conversations over and over and over again. Well, guess what you could solve? You could just sell it today, defer the tax, invest and diversify the income stream, and then when upon your passing, it just seamlessly start to pay the kids out 25%. In other words, you can decide right now to take control of your estate planning, future and have peace with it right now without having to feel like you're stuck between the stepped up basis upon dying, which is never a good thing to have to wait for something until you die. Because guess what? Once you die, it's not for, you're not enjoying, the outcome of that. And just selling now and enjoying, life and having those freedoms. In other words, have some estate planning peace. Jake, you want to add or subtract any of that, or any comments on that?
Sometimes I talk about the deferred sales trust as a financial tool, which it is. It's a financial instrument that allows us to do things in a more efficient way for tax purposes as well as growing our wealth. Essentially, though, it is a keystone strategy, whereas if we're utilizing it, a lot of these other strategies can kind of fit in the archway where the keystone is the deferred sales trust, and we have a charitable trust here, we have estate planning here, we have life insurance here, we have investments in the market here, etc. The trust allows us to put everything in the right place, and it all holds together a little bit well, just like the archway. And so that's just something I like to add over here now.
No, I love that. The cornerstone, that's so true. And you can do it at what's called optimal timing too. It's really nice. So if you're selling Ethereum, if you're selling Bitcoin, if you're selling highly appreciated real estate or a business, optimal timing can look in a couple different ways. Number one, you can sell it perhaps the peak or a high place where it's a seller's market. And then you can invest back in it dollar by dollar cost averaging by investing back maybe when things drop. I know for a client of Jake and I, we did a Bitcoin exit where she exited $5 million at 54,000 a coin. And for her, that was optimal timing for what was 50,000 and went to 50 million. She exited 5 of that 50 million. At 60,000, 65, 68, she decided not to. Looking back, obviously, hindsight's 2020. But guess what? She can still buy back, Bitcoin or Ethereum at a lower price while it's down. And the deferred sales trust gives you that ability to do that without having to suffer the tax consequence today. In other words, you can defer that tax. So optimal timing is for selling and financially making prudent investments. It could also be optimal timing for just your lifestyle. We have a lot of our clients are looking to, spend more time with family, spend less time on work, and or take a few years off while they transition from a big business exit where they poured in 10 or 20 years into it, and they want to take a break. I know one client we're working with, he's selling a business, and we asked him, well, what would you do if you sold? He goes, well, probably for the first 6 months, I probably wouldn't do anything at all. Probably would just observe and reflect and travel and take some time off. And then I'd probably jump right back into something. And if the trust can be that joint venture partner to do that and optimally time my lifestyle, wow, that'd be fantastic while still making a return while we're waiting for that. I know we're seeing a lot of real estate clients thinking the same thing. They're selling high of their real estate right now. They're getting in liquid diversified positions, and they're waiting for the marketplace to shift, which we think it's already happening with real estate. But there's going to be even more opportunities within 3 to 6 months, and then 12 to 24 months. Some substantial opportunities for folks that are patient and have the capital and have liquidity and have the expertise to execute on these opportunities when those that were perhaps over leveraged didn't sell high, perhaps did a 1031 exchange instead of using the deferred sales trust, are not in the position to execute on that. And so if you want to learn more, again, you go to capitalgainstaxsolution.com. You can also connect with Jake Miller by going to strategictaxsolutions.com. That being said, I'm ready to open it up for anyone who's on here with a live deal or a question about the deferred sales trust, or just a comment on anything that we've been talking about. So I'm going to encourage you to unmute yourself and or put a question inside of the chat. I do see Todd, welcome. I see Yazrith, welcome. I see Maria, I see Felipe. I see Biz Accounts and Alan. So if anyone has any questions or thoughts, feel free to unmute yourself or put it in the chat. And Jake and I are happy to have a little discussion or answer any questions you have.
You know that, Todd, we had a discussion a few weeks back, and it's good to see you here on the call today. And hopefully we can meet up again and discuss a little bit more your financial practice and the legal side of things of what you do for your clients, how the deferred sales trust might be able to help.
Yeah, thanks, Jake. I'm a tax attorney, so could you, I'm just trying to learn a little bit more and understand how the trust works. It sounds like there's an independent trustee. Is that somebody that's chosen by y'all, or is it by the client? How much do they charge? Is it somebody that's well known? Who are the beneficiaries of the trust? How do we get the deferral? All those sorts of questions.
Yeah, so I'll answer a couple of those, and then Brett, I'll let you kind of fill in the gaps. Independent trustee is somebody who is well known by the law firm. For them to be truly independent, we go to the extreme of making sure that they're not somebody that the clients worked with before, in the sense that they're not somebody that, and you can respect this from the legal side of things, not somebody that could be deemed to have power, control, or authority, not the best man at your wedding, not your friend, your uncle, your cousin, not your spouse, and not yourself. Somebody who literally doesn't have a financial or an incentive in any other aspect, so they truly can be a fiduciary of the trust and trust assets. Now, when I say very well known to the law firm that stands behind this strategy, it's because the law firm provides lifetime audit protection, and they heavily vet the background and the ongoing dealings of the trustees to ensure that moving forward, these are individuals that can be trusted with sometimes billions of dollars that transfer without paying taxes. I don't know if you want to add something there, Brett.
No, Todd, those are great questions, and welcome to the mastermind. And so, yeah, I think for a tax attorney like yourself, most, Todd, want to speak with tax attorneys directly, right, and learn. My background is one of real estate, 1031 exchanges, and just fell in love with the strategy and became a trustee. Since working with the structures since 2009, became a trustee about 5 years ago. So the main thing, I think you also asked about the beneficiaries. So the beneficiaries, it depends on what kind of trust we use, Todd. The first trust we use, the owner or the seller of the asset cannot be the beneficiary. In fact, if they were, or the owner of it, they'd be selling it to themselves, and it therefore be taxable. And so the actual beneficiary, or it's not even really a beneficial interest the way we set it up. It's a business trust that doesn't have beneficiaries in the traditional sense, because this is not a contribution to a trust. It's actually a sale to a third-party trust, a business trust, of which what you're doing, the seller is loaning the funds to the trust in exchange for a promissory to pay them back over time. And so it's actually a shareholder, and the shareholder is actually my company, Capital Gains Tax Solutions. We're the sole shareholder. Now, these individual trusts are never commingled in business accounts. They're never in personal accounts, of course. They're never any other trust accounts. So this is not like a pooled investment. They're single entity trusts that only do business with the seller of the asset, and if there's married, their spouse. And all the money's owed back to them. And so they're a secured lender that has loaned the money to the trust in exchange for the promissory note, not the beneficiary of the trust, nor the owner of the trust, because that'd be taxable. So that's the first DST. Now there's the DST 2.0 that the beneficiaries, the way they can be structured can be the children. And it might be something you've maybe used before, but no charity is required. And this also eliminates the assets outside of the taxable estate. And so their children can inherit it estate tax free. That has been audited, by the way, which is really important. The track record quickly for any of this is close to 30 years, thousands and thousands of closes, billions of assets that have been, values of assets been used, and over 24 no change IRS audits, including a private letter ruling, and including national law firms that reviewed it. And so far, there's never been a change on any of the audits, state or federal, and the tax attorney or business partner who provides the lifetime audit defense is the one that defends with the law firm each individual client. And so the cost, I think you mentioned that, there's a one-time cost set up front of about 1.5% on the gross sales price. That's the tax attorneys who create this and structure that. Excuse me, we work on a conditional basis, meaning it's 100% conditional. If it doesn't work out, if they don't want to use it for any reason, we don't charge anything for all of the planning, the trust formation, working with the M&A attorneys, working with the real estate professionals, brokers, all of that. It only gets charged if and when the deal closes and if and when the actual client decides to use it. So it's 1.5 on the first million. It's 1.25 on anything above that. That's a one-time fee. As far as the trustee, that is my company again, and we charge on a recurring basis, annual basis, to manage the trust, work with the financial advisor. Simple math, if it were Jake and I, Jake is the financial advisor here, me as the trustee, it's somewhere around 1.5 to 2% on a $1 million deal. To keep it simple, about 15 to 20,000. Our goal is to net the client typically 6, 7, 8, or 9%, depending on their risk tolerance, net of recurring fees. So let's say it was 8, it'd be 80,000 on interest on $1 million. Our goal would be to try to earn about 10, not a guarantee. There's nobody personally backing any of the loan. We do want to make investments that are prudent based upon their risk tolerance. And our goal over a 10-year period is to earn about 10 on average per year, to net about 8. And that's also why we have the $1 million net proceeds, $1 million gain. But our charge is about 1.5 to 2%. I think that answered most of your questions, Todd. But do you anything you want to follow up with there, or anything that I didn't answer? You can go ahead and let me know.
The only other thing is, could you help me understand a little bit better how the tax is deferred in the trust?
Yeah, sure. Yeah. So the first one is just a promissory note. It's known as IRC 453, as you're familiar with, right? It's a seller carryback. So if you, Todd, owned a $10 million apartment complex free and clear, let's say you've owned it for 27.5 years, it's fully depreciated, and a buyer shows up, they could give you $1 million down payment, and you could carry paper for $9 million. And on that $9 million, you haven't received constructive receipt. You're in a deferral on that $9 million you pay tax on. In our scenario, what we do is we say, hey, don't finance the buyer, Todd. We want you to finance the trust. So you as the seller would finance 100% of the trust if you wanted to, let's say all 10 million, and you are selling the asset to the trust in exchange for the promissory note. And that's what your new asset is, the promissory note. And the ultimate buyer who's already lined up, they buy the asset from the trust. The trust bought and sold for the same price. So there's no tax at the trust level, since there's no gain. And the trust owes you back that 10 million plus a rate of return. And so that's just IRC 453. 10 million is the max before there's an interest charge for a married couple, as you're probably familiar with. 5 million for someone who's single. And so for deals that are 10 million per married couple per year, we typically do the DST 1.0, and it's just a traditional pure installment sale. They will pay tax on the interest they receive as they receive it, and they'll get a 1099 for that. So on the 10 million, if they receive the interest only payment of 800,000 per year, they'll get a 1099 for 800,000. They'll pay ordinary income tax on that. If they dip into principal, they will pay capital gains tax on that amount. So that's DST 1.0. Any questions on that 1.0, Todd?
No, that makes sense. Thanks.
Yeah. On 2.0, it's a little bit different. It's a combination of principal and interest payments based upon the life expectancy of the ultimate sellers or the note holders at this point, right? It's a different tax code that with NDA and larger cases that are reserved for typically $20 million deals and above. We're using those cases for, and it's mainly an estate planning exit outside of the taxable estate, which is different than 453, which is not, there's no stepped up basis there. And this other one, essentially, it's a mix between principal and interest payments based upon life expectancy. Well, they'll pay some cap gains tax over their lifetime, but upon their passing, their kids can inherit it, capital gains and estate tax free, depending on how we structure it. There's a lot of depends here though, Todd, right? As you know, there's different circumstances and different fact patterns. And so what we do is we really try to just understand the fact pattern, understand the entity formation, the ownership, the timing, the risk tolerance, and build a team and build strategy or strategies. Sometimes it's 1.0 and 2.0. We're doing a combination for sales and collectively then execute on that with the investment. So it's not just as you probably are aware, and I'm just sharing this for everybody else, it's not a one-time setup and you're good to go. It's a C corp business trust is a good way to think about it. And collectively, we have to execute the ongoing, reporting and execution and compliance to make sure that we stay in line with what the tax attorney has created, really perfect it. It's never had to change yet, as long as we stay within the guardrails. So Todd, any comments or thoughts on that? Because I'd love to hear your thoughts, because I imagine you get approached with a lot of stuff, being that you're a tax attorney.
Yeah, no, it's very interesting. Thank you for the explanation.
Okay, thanks, Todd. Appreciate it too. Does anyone have any questions and thoughts, comments on anything that was just said? I'll encourage. We have biz accounts. We have Felipe, Maria, even Rebecca. You can jump back in and say hi. And what's your thought of or questions or thoughts on that? Or even Jake. Jake, what do you think about that?
Brad, I think that this go around you explained the legal aspects of how the trust works and the 1.0 and the 2.0 very, very well. I think that helping clients understand perhaps a couple more scenarios when it doesn't work or when somebody is not a good fit. And we talked about the scenario where, based on the death of the owner, step up in basis to the heirs or the kids, that's perhaps, one of those times that it just doesn't work, or it's not the most efficient tool if the desire is to pass on a thing rather than selling that thing first. Another scenario is, of course, the goals and objectives for the proceeds of the fund. If the goals and objectives do not align with reinvestment, they do not align with, hey, I need to continue to make that money work, which causes an exchange of GDP and exchange of money movement, everything else in the economy, which is great. If it's just, hey, I want to go buy that car. I always use the example of the client that spent 3.5 on a crazy Lamborghini, 3.5 million, and that just was not a proper use of the trust. So that was just taxable distribution to her. When else does the trust when do we not recommend the trust, I guess, is a good way to phrase that.
Yeah, great question. I think if you have a great 1031 exchange lined up, I've helped clients do 1031 exchanges, help clients collectively over $500 million of exits, mostly in multifamily investment real estate, part of where I started out at Marcus & Millichap. So if you have a great 1031 exchange, fantastic. Do a 1031 exchange, cost you about $1,500. It's simple. It maintains the stepped up basis. If you found a nice deal that makes sense, continue on. It gives you capital gains tax deferral, and you can build wealth. The top 3% of wealth in America owns commercial real estate. So I think it's great. Multifamily housing in particular, there's about 4 to 5 million units short in the U.S. alone. So we think it's actually it's a nice investment in any kind of environment. So I like 1031 exchanges when the deal makes sense for you, meaning the tax tail's not wagging the investment dog. Number 2 would be, you do have a health concern, right? Or your health is uncertain at this point, and there's an opportunity for that stepped up basis. However, your net worth is less than 24 million married, 12 million single, approximately, adjusted for inflation. However, in 2026, those amounts are cutting. It looks like they're cutting in half. Maybe who knows if anything will change by then, but it could be 12 to 14 million married, 6 to 7 million single, adjusted for inflation. And so realizing that stepped up basis does not solve for a state tax, death tax 40% on anything above those exclusion amounts. And so I think it's important to identify what challenges each individual is facing and how you're going to mitigate those things. And so I would say those 2, and then also donor advised funds are also very attractive as well. If you're really charitable inclined, you can use those to help with tax and help with be able to give back to causes you believe in most. Most of our clients are charitable; they're just not 100% charitable. So you want to be, maybe do a little bit of both. And by the way, we work really well with solid 1031 exchanges. Sometimes we bifracture a 1031, and we do a partial deferred sales trust, a partial Delaware statutory trust, which is another form of a 1031. And sometimes clients like to diversify with that. They don't want to maybe go all in on the deferred sales trust. They want to do a little bit of each. And so we just did a deal out of Texas for a client who bought a deal, property on 1031 in Oklahoma, a property in South Carolina, and then they put the rest of it into the deferred sales trust. Sometimes they have a mortgage over basis issue or debt over basis. And so the deferred sales trust cannot solve that. In fact, we need to replace that debt over basis if it's a 1031, typically via a Delaware zero coupon deal that replaces that debt. If you're not qualifying for a 1031, since maybe you're not selling investment property, then you need to pay that debt down to the basis, right? And/or we're looking at a strategy now, in fact, for a sale for a client where they have substantial debt over basis, but they're not planning on doing a 1031. And so what we're looking at, and we'll maybe talk about this next week in detail, but essentially them going into the deferred sales trust, closing even though they have debt over basis, but then turning around in the same calendar year, which is 2023 right now, and buying enough real estate with the new depreciation schedule, using the joint venture LLC structure that we do with the trust to establish not only new basis, a fresh basis there, but then cost seg that to create a paper loss to offset the what would have been the debt over basis tax. And so that's a bit complicated and kind of intricate, and I'm curious to see how this one turns out. We haven't quite done it in this order yet, but that is also some of the things that we'll look at. So the answer, Jake, is it all depends. It all depends, and we'll be the first one to tell you it's not a great fit. Either your deal is too small, or you want too much control, or you want too much, spending on your own personal primary home or something like that. That's also, again, why we work on a conditional basis. For any reason you don't want to use the trust, you don't pay us anything, right? And we'll do all of the planning, do all of the underwriting, do all of the, give you the options and let you decide. So, Jake, does that answer the question?
It does, and I think that's very helpful for some of the replay. We have some individuals that are actually commenting in the chat asking if we can send them the Zoom recording. I mentioned, well, I was going to mention, it looks like I forgot to hit the send button, but the replay of this will be found on both of our YouTube channels as well as my LinkedIn. And so that's going to be available for everybody.
Absolutely. And then what are those YouTube channels for Jake Miller? What are they? And then I'll tell you mine.
Mine is Miller Financial on YouTube. If you just go in for Miller Financial, you have a channel there where all of these are replayed. Go ahead, Brett.
Perfect. Yeah, and then mine is Capital Gains Tax Solutions on YouTube. So it's Capital Gains Tax Solutions. You also go to capitalgainstaxsolutions.com. And by the way, Jake, the book just came out, right? Building a Capital Gains Tax Exit Plan. We call it the Proven Playbook to Unlocking Your Ideal Wealth Plan for yourself or for your clients. We do have Jake in the book as a chapter. We also have Kevin Harrington from Shark Tank in the book. And I've got a few chapters as well. You can check that on Amazon. It's called Building a Capital Gains Tax Exit Plan. Go to Amazon, pick up your copy today. That being said, does anyone else have any more questions for us on this Friday before we encourage you to have a great, great weekend? Okay. I think we did our part today. Jake, we did our part. So
very good. Well, thank you. Thank you everyone for being here today. And of course, if you want more information, both Brett and I have some websites. If you go to strategictaxsolutions.com, you can find an area there where you can book an appointment, as well as we have an 800 number, 1-800-773-1848, as well as Rebecca, if you're in the Lake Tahoe area in Truckee, tell us how people can get in touch with you.
Sure, they can get a hold of me at RebeccaMunson.com, or they can find me on Facebook or Instagram, YouTube. All of those are Rebecca Munson and MONSON. Yeah.
Very good. Awesome, Rebecca.
And of course, Brett.
I'm putting on the chat right now so people can see that on the screen. RebeccaMunson.com, RebeccaMonson.com. Thank you, Rebecca. And if people want to get in touch with me, you can go to capitalgainstaxsolutions.com. It's capitalgainstaxsolutions.com. Thank you so much, everyone, for either watching this replay or being a part of the mastermind. We so appreciate everyone out there. We'll encourage you to join the mastermind. Go to capitalgainstaxsolutions.com and you can register there. It's 10 a.m. every Friday Pacific Standard Time, 1 p.m. Eastern. and we look forward to next time. Thank you so much. Take care.
Recording stopped.